If you're waiting for housing to go to 2008 prices, here's the uncomfortable truth. The belief that you rely on is simple. If people can't afford homes, then prices will fall. But looking at 50 years of housing and economic data, the truth is that housing prices don't need to be affordable to continue to increase. And the cleanest way to explain this is through monopoly, because monopoly shows three things clearly. The property goes to the player who plays, that ownership feeds on itself, and that the rules matter more than the players. And this matters because if your entire housing plan relies on prices becoming more reasonable, you need to understand what you're betting against. Not just that housing prices are extremely expensive. Everyone can agree with that. But you need to understand that you're betting people who have purchasing power are going to disappear. Let's start with something that doesn't make sense. Housing is less affordable today than it has been in almost all of the last 50 years. And I'm not just talking about that the mortgage payment takes up more of your income. That's true. Or that qualifying for a home is harder than it has been in the past. But even saving for a down payment, with how expensive inflation is, it has never been harder to save for a down payment than it has been today. And yet in many markets, prices are still extremely high. And look, not everywhere, but housing prices in the long run have continued to climb even when affordability has gotten worse. And look, in most areas of your life, if something is unaffordable and everyone in this situation assumes that the market is wrong, we're eventually going to see this huge crash back to a much more affordable level. And you can understand why people feel that in most areas of life, that's how it works. If used cars become too expensive, people stop buying cars as often and prices drop. The same thing if prices at restaurants become too expensive, people eat out less. Because a product that's priced beyond what a customer could pay, demand usually falls. And after demand falls, prices go along with it. But housing behaves differently. And there's a few different factors as to why that's the case. The biggest one being that housing isn't priced on what the average person can afford. It's what the winning buyer is willing to pay. So for a second, I want you to imagine a $900,000 house. The average person cannot purchase this. A first-time home buyer making amazing income, having a half-decent down payment saved, will say, these payments don't make sense. This is ridiculous. And they're not wrong, but then somebody buys it and they think, wow, that person is an idiot. But when you look deeper, and what I see all the time is just the buyers coming from a different place. Some have just sold a property and are moving up into this type of home. Others are getting parents to help, or maybe an investor using their own assets to buy it. The average person, they couldn't purchase this home, but the buyer did. And if enough homes keep selling this way, then prices will continue to climb. And housing doesn't need a reset, even though the average person can't afford it. And when it comes to this conversation, this is the first mistake that people make. They assume that affordability is what drives prices. It's not, its purchasing power. And often those two things are said to be the same, but there's an important distinction. So affordability is what the average person can buy. And then purchasing power is those people who are in the market, what they're able to purchase for. And to illustrate this, I want you to imagine 100 people. All 100 want to purchase the same home. 90 people can't afford it, and 10 of them can. Well, the average person, so on an affordability level, 90% of people can't afford the home. But the house is going to be sold to one of the 10 people who can afford. And when we look back, this is the first lesson that monopoly teaches us. The house doesn't go to the person who needs it most. It's the player who can pay when they land there. And this is where a market can feel expensive and stay expensive, even though the average person can't buy. Now, the obvious question you're asking is, how do these people get their money? Well, it comes from a bunch of different areas. People invest in the stock market, own property, get a gift from their parents. All of these things allow for them to not just use their income, but also assets to purchase. Again, the argument usually stops that wages have not kept up with housing prices or asset prices. And that is true. The issue is houses aren't only bought from wages. They're also bought with assets. And this is why you can see a couple who makes $180,000 a year, who looks at a house in their area and says, this is too expensive. I can't afford the payments. And another couple who makes that same amount of money, who ended up selling another property and moving into this, feels like those payments are comfortable for them. They're not playing the same game, even though they look the same from the outside. Again, if you want to understand, affordability is what the average person feels the market is like. And purchasing power tells you if the strongest buyers can continue to buy. The prices are set by that second group, not the first. So where does this purchasing power come from? This is where we need to look at monopoly again. When we look at the data for the last 50 years, ownership creates equity. And equity creates buying power, and that buying power can create more ownership. This is the ownership loop. It continues to cycle. When we look at wages versus assets, and when I talk about assets, not just talking about housing, let's look at the stock market, gold, silver. All of these had strongly outperformed wages over the last 50 years. These things that you own, they grow in value, and that value allows for you to purchase more things that continue to grow in value. And this cycle and this loop is exactly how monopoly is played. And here's the thing. Let's say someone bought a house 15 to 20 years ago. At the time, that house felt expensive to them. They might have stretched their budget. But over time, they paid their mortgage. That house increased in value. And over time, they had an asset. And that asset gives them options. They could renovate, pay off some debts, maybe purchase another home, invest in the stock market, help their kids out with the purchase of a property. Ownership created this buying power, not just your paycheck. And in Monopoly, we understand this so simply. Nobody's strategy is to go around the board as quickly as you can to collect a salary. If you want to win, you need to own part of the properties in order to have a chance. But when you own an asset that's of value, part of your wealth continues to grow even when you don't work another hour. And look, I'm not saying that it's effortless. I'm also not saying it's without risk. But historically, ownership is a second engine that continues that a person who earns a wage alone doesn't have access to. This is what we see in real estate conversations all the time. So many people say that this doesn't make sense, but they're not understanding that other people are coming with assets to purchase these properties, not just income. And the problem is that the more these assets rise relative to wages, that housing prices can continue to detach from wage growth. And how we see this in monopoly is through rent. In housing, it shows up in equity in your home. And you might be thinking, doesn't this make this whole system unfair? And this is exactly why these debates get so emotional. When buying power is coming from previous ownership, when you enter the market, matters a lot. And the frustration that young people feel today is that they feel like people already started with assets and they're starting from scratch. It's that the market no longer feels like there's a fresh starting line. It's like you're joining a Monopoly game 3 hours in. Some buyers already own property. Others are carrying years of equity, and a growing number of people are entering the market from decades of appreciation of homes that their family members lived in. And meanwhile, a first-time homebuyer trying to enter the market without all of this help feels like they're fighting an uphill battle. And this is where most housing debates, they go sideways. They want to pick a villain. But before you blame the player, you have to understand the game. And again, for those people who already own real estate, you've got to understand how this feels for young. Imagine sitting down in a Monopoly game that's already started. One player owns half the board. Others have hotels on their property. And you're given a small sum of cash and said, good luck. Those people who weren't able to get assistance, who feel like they're joining the game late, feel like everybody else has an advantage that they don't have. And are there people who are successful in that scenario? Absolutely. But is it harder for those people than it is for people who have the ability to get some money from family or who have already owned a home? Yes. And so when things get heated, when they're debating pricing, they're not actually debating pricing. They're debating access. They're debating opportunity. They're debating whether housing still works for that. And just to be clear on the other side, if you don't own a home, this doesn't mean that homeowners are greedy, that landlords are evil. It also doesn't mean it's your parents' fault for not owning a property. None of that's true. The point is just so much simpler than that. When asset prices continue to grow, those that have entered earlier are going to reap the most reward. Not because they're better or they're smarter, but just because they got started earlier. And you might be saying, Jeff, you're comparing Monopoly to the housing market because it's got streets and homes. And that's not the case. What is actually important to focus on is the rules themselves. Most people don't know that Monopoly actually was a game stolen from Elizabeth Magie called the Landlord's Game. And the game was not created to see who won. It was actually created to say, what do the rules produce? And there were two different sets of rules. The one that we know and stuck around shows things really well. The outcome that it shows really well is this. When ownership is awarded long enough, ownership concentrates. And this is why monopoly works so well as a housing analogy. It's not that housing is exactly like a board game or the fact that there's hotels and houses and streets. Real life is much messier than Monopoly, but the core of Monopoly holds true. The game of Monopoly doesn't feel unfair at the start. There's no ownership. Once rents start being bought, rent flows to owners. And play the game long enough and ownership starts to concentrate. And look, this is not a glitch. This is part of the game. Nobody leaves Monopoly surprised that one person owns the whole board by the end. And now let's bring this back to housing. When a system rewards ownership for decades, owners don't just gain a place to live, they gain equity. And that equity, it turns into buying power, and that buying power helps themselves or their families buy again. Meanwhile, people outside this ownership class continue to try to save money from their wages and just can't keep up. The system, it doesn't require everybody to keep up. It just requires those who have advantages to continue to have those advantages over time. But what's interesting is that's actually only half the lesson. The landlord's game wasn't celebrating monopolies. It was exposing. The second part of the game was asking a different question. Is there a way that everybody could stay in the game for long? What this game was trying to expose was this. Most people blame the players, immigrants, governments, landlords, pick your villain. And look, depending on your market, some of these have some factors into why housing is more expensive. But the bigger question and the more likely scenario is that the game itself is designed to reward ownership over income. And look, I understand why this happens. Blaming an individual is way easier than blaming the system. So now you're thinking, thanks, Jeff, you've got me depressed. What should I actually take away? And this is what I want you to think. What I don't want you to take away is that housing will never fall. We've seen recently that that's just not true. But what it does mean is just because housing is unaffordable doesn't mean it's about to collapse. Before this video, you might have thought, hey, people can't afford this house, so housing has to collapse. What I hope that you're going to take away instead is that prices aren't set by the average person. They are set by the buyers who actually have the purchasing power. And in a system where ownership creates more ownership, ownership is going to come from equity, from family wealth, from stock markets, and business creation. You may still hate the answer. You might still think that it's unfair, but at least you understand the force that keeps it moving. And if you want to understand how Canadian housing got to where it is today, watch this video next.